Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss 3 ideas to improve machine learning trading strategies.
Hello everyone, my name is Radovan Vojtko, I'm CEO and head of research at Quantpedia. Today we will discuss machine learning. Machine learning models are well known and are used for tens of years in algorithmic trading and in the trading strategies. More and more people are using them, and it also means that they are slowly but surely losing some alpha. Now the question is what we can do with that, and we have few ideas regarding machine learning models, and we will go through 3 of them. Firstly, I will discuss a little more about machine learning. So as I said, there are a lot of trading strategies that are built based on machine learning models and machine learning ideas. We have nearly 100 of them in our database. Here are 3 articles that we discussed in the past few weeks on our blog about machine learning and how to improve them. The first article is called Decreasing Returns of Machine Learning Strategies. It's an article based on a study written by Zakichi, Fiber, Vojtko, and Zaremba. The authors employ a lot of machine learning models to investigate the return predictability and use 150 stock characteristics from the US market on a data set that's spanning nearly 50 years. They had 2 goals. They were looking to test those characteristics and to build machine learning models. They were interested to see how they fare over the time. Here is the most important picture from the research, and it's showing how the predictability changed over time. So here we have what were the returns in the years 1982 until 2000 with the usage of machine learning when the machine learning was quite new. Based on the annual return forecast and monthly return forecast, we can see that on a monthly return forecast there was a healthy alpha spread for portfolios built on machine learning models between the big and the small companies, and of course there was significant performance on microcap companies, nearly 40%. And the chart is also showing that the spread is narrowing, and it's even negative on annual return forecast between the large cap stocks, and there is only significant spread that remains in smaller microcap stocks. That's something that we are always repeating when we explain something to our clients. Yes, of course, if you want to improve your strategy, it's better to use the strategy on smaller illiquid stuff or some exotic assets than use it on some really liquid and big universe like large cap stocks in the US. Of course, there is still some spread, but machine learning is not as good as it was, 10 or 20 years ago. What is the other interesting picture for the research paper is this one, and that's the aggregate variable importance per category. So this is very important picture in my opinion, because it shows what are the variables that are important in the machine learning when you train the machine learning models and which you can use to predict the performance. What is the most surprising for me is how big the category of trading frictions is on a monthly return prediction. So what does it show is that nearly 40% of the anomalies that show predictivity and that are used in machine learning models are the trading frictions predictors. So it means the spread, the liquidity of the stock, etc. So that's something very important. It's maybe a very good idea to include the trading frictions predictors into your machine learning model. We do not see that often. A lot of the time only the trend-based or price-based predictors or fundamental-based predictors like value, investment, profitability are used. But here we can see that over 40% of the predictors that make sense are predictors based on the trading frictions. So that's the first important thing that we can take from this research. Now let's review the second research paper. The second research paper is written by Creed Howard. It's called Less is More: Reducing Biases and Overfitting in Machine Learning Return Predictions. This is the paper that tries to improve the machine learning models, and the idea is that we should not train our models on the whole investment universe, all of the stocks, but we should split those stocks into multiple groups, and we should train group-specific models. The authors try to spread the investment universe into groups based on the size. Then they train models independently on each size group. So they have 3 different sizes group, or 3 different groups of different size: the small, the middle cap, and the large cap stocks. And there are different predictors that are better for predicting the small cap stocks, different to predict the mid cap stocks, and different to predict large cap stocks. I mean, it's a very simple idea. When you think about it, it makes a lot of the sense. It can improve the machine learning models a lot. So do not try to predict all of the stocks from whole universe. Try to split it into smaller parts and try to predict the smaller parts. I mean, you can improve your machine learning model by a lot. Here is also another interesting picture. It's a figure 3. Once again, it shows the feature importance when trading in size categories. What is interesting here is that authors did not include the trading frictions. If you take a look at that picture, you will see that there are mainly momentum-based, price-based, and fundamental-based predictors. So they do not use trading frictions. So if they use the trading frictions, I would think that the models that could be built would be even better. But what is the most important to realize is that as we move from the small size group to the large size group, the predictors that are really important very change. So there are different predictors that are important in a small size group than there are in large cap group. That's the second important paper. Now, the last important paper that I would like to mention is from the Sak, Cheng and Huang. It's called Exploring the Factors of the Machine Learning Portfolio. What is interesting about this paper is the idea that the machine learning models are not static. It means predictors change over time. Predictors that were important 10 years ago are not important at the moment. So as the economy shifts and changes, the predictors also changes. So there are patterns that are aligned with the different states of a credit cycle, with the economic cycle, etc., etc. And there is credit expansion and credit contraction going on in the economy. And as the economy changes, also the predictors that can predict machine learning models change. So when you are building the machine learning model, it makes sense to incorporate the change of the economic environment or macroeconomic environment into the machine learning model. They also have some interesting charts in which they show how the economy and how the macroeconomy changed over the time and which predictors were more important and less important over the time. These are the 3 important papers that we identified over the last few weeks or 3 months. They do not include trading strategy per se, but they show very good ideas that can be implemented to build a better machine learning model. So when you are struggling to build a machine learning model that predicts the stocks, you should take a look on these 3 papers. I hope that you like this video. I also hope that you subscribe to our channel. There will be more and more content regarding trading strategies, regarding the factor investing, trend following, machine learning, etc., etc. So I hope that you will join me in the next video. Thank you very much.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.